Namaskar. So this is an update after the Fed stayed pat on rates last night, and then there was this global rally. So how where does India stand? And of course, there was a fantastic rally today. Sensex has closed above 70,000 for the first time, and Nifty was up another 1.25%. So about 21,000 decisively and 21,200 types. So big move in equities in the Indian markets, but it starts with bond markets. So I mean, it starts with interest rates. So this is that main idea which I had published. Long time back, and it was an editor's pick, and then I've been constantly updating it. So today's video is also an update of that idea. So how bond yields are impacting currencies, how bond yields are impacting equities, where's dollar headed, where's crude headed, and all those things matter for Indian equities, because Indian equities are affected by all these factors and more. So let's try to look at some of them. So the big news, the big trigger yesterday globally was Fed stayed on its interest rates. And if you look at the news on the bonds, now just if you see what happened was after that rate, I mean, not only did Fed not cut, there was an almost indication that next year we are looking at almost 75 basis points of rate cut by the Fed. Now that is really what has triggered this big rally, and it is just the beginning. So let us first try to see how globally bonds have reacted. So you can see South Africa 10-year yield has dropped, India 10-year yield has dropped, France 10-year yield has dropped, Italy 10-year bond yield, Lithuania, everybody, UK, Malaysia, everywhere, Portugal, everywhere, Australia, France. So this is the first thing, that the moment US did not raise rates, and going further, it says that there's a uh, high chance of interest rates being cut by almost a seven. Now, if the quantum is 75 basis points is what the market is working with, then it can't be that 75 basis points are cut, let's say in December 2024. They will have to stagger it. So it's not just the magnitude of cut, but it's also the timing of the cut. And therefore, what is being anticipated is that the rate cut may start earlier than anticipated, because such a big rate cut has to be accommodated. So this is all market talk. Things can change, but still, where after the yesterday, uh, the Fed has almost started a party on all global indices. So this is what is the thought process is. So step one, yield. Now we have got US 10-year yield. You can see this. This is the daily chart. I have shifted to the app, so I'm graduating slowly on TradingView. So the yields are edging down. This is the US 10-year, US 1 year. Now US 1 year is still above the US 10-year. The curve is still inverted, but nevertheless they are coming down, and who knows, going forward the curve may become flat and normal. But for the moment, the yields are coming down. The 10-year yield is coming down. This is the first thing that happened. This is the US dollar index at 1.102. So this green line is the, let me so this green line, it's coming down. So the US dollar index, it's at 102, and it's, so there's a gradually from 106 to 5 to 4 to 3. Who knows, it may be going below 100 in the next few weeks or months. And if the dollar index starts going down below 100 and in the double digits, then that means the dollar in general is weakening. And when the dollar starts to weaken, that means that the money is coming out of USA, and it is going into all other assets. So it may be, so commodities may see a run, because a lot of liquidity flushes the global economy, and then that can be inflationary. So crude oil prices can start rising. irrespective of demand or something. Purely liquidity, excess liquidity can lead to inflation. That's what the logic is. So the same thing can happen to India also. And this candlestick chart that we are seeing here, this blue and red lines are the US yields, US 1 year and US 10 year. This candlestick is the USD INR, and you can see that, you can see this candle, it's still forming because and we are at 83.26. So there is clearly, and 84, 83, 83, and 82. So if this candle comes down, it means the rupee is appreciating, because 83 to 82, 82 to 81, so that is, the rupee is becoming stronger. So this is what happened because of Fed's move yesterday. There was a sharp jump, if you will, in the rupee, and that's globally that's happened because the US dollar index has weakened. See, if the dollar is itself weakening against six major currencies, or again, so generally dollar weakness can be seen here, and therefore the rupee strength. And this further implies, now look at these black and yellow lines. These are India 1 year and 10 year bond yield. They are almost at the same level. This is the India's yield curve. You can see the 3 month yield is at 7, and the 40 year yield is at 7.5, 7.4, less than 7.5. So you know, over a 40 year period, if you are getting like 0.4% premium, that means it's a flat yield curve. It's an absolutely flat yield curve, and that's what we can see here, that 1 year and 10 year are both at the same level. So Indian yields have, while the global yields were going up, we have done, in fact, that is what this video was all about. The first one, that impact of bond yield differential on equities. So where we had said that, in that, even when US yields were rising, short term as well as long term, Indian yields stayed flat. And therefore now, as yields, now all this turmoil period is gone behind, and now the Goldilocks period is starting. And once that happens, so when the global yields were rising, India managed its yields very well at the cost of maybe forex reserves. But so it did not let the yields to rise, it did not let the rupee to really depreciate beyond the level, because of this huge forex reserves, $680 billion, $500 billion, $600 billion. So RBI used it very strategically, and now that worst phase is behind. Now the question is, as interest rates globally start coming down, there will be two things happening gradually. There will be two things happening simultaneously. One is, money, dollars will start flowing into other assets, and that means the demand for rupee will automatically increase. So there will be an upward pressure on the rupee. So we can see rupee going from 83 to 82 to, I mean, I'm just giving the direction, 83 to 82.5 to 82 to 80, like that. That's what the rupee strength, because the dollar is weakening now. Will RBI want the dollar to weaken or the rupee to strengthen? Because if the rupee starts strengthening, it will have its different problems for RBI. I mean, there will be a flight of capital. Foreigners may not find India that much attractive for foreign travel. There's a whole different thing. But RBI will be in a very enviable position, the India Central Bank, because money will come in. Now it will be, now this money will come in because of India's better fiscal. Just few days back, the GDP GVA data was released, and India retained the tag of being the largest, fastest growing economy, in real terms. And there's one important point here, that in spite of all this, what happened was, last time was that the consumption expenditure did not grow as much as people would have liked. And the reason for that was, like it grew at hardly 4.5%, whereas the bulk of the growth was happening in manufacturing and all. So one big reason was that the big festive Diwali season was in Q3, October, November, December. So if that also starts contributing, then the consumption will also contribute. If global economy starts reviving, then net exports then net exports will start becoming better as a percentage of GDP. So all in all, we are at that inflection point of a multi-decadal economic expansion at a lower inflation rate. So I had made this video. If there's a global party on, India is going to lead, and one after another, things are falling in place. The building blocks are coming in place for the economy to perform. So we have consumption in place, we have inflation under control, we have bond global. First, let's talk about global. We have consumption coming in place, we have inflation under control, we have public debt to GDP which is very sustainable. India is on its path to growth by the uh, fixed capital formation. That means you can see gradually that fixed assets, I mean capital investment led growth or capex led growth is what is happening in India as compared to the earlier consumption led growth. What would happen is if you increase wages, like what most of the global economies did during COVID, they just pumped in liquidity. Now, consumption did not increase during that time because there was fear, but nevertheless, the balance sheets increased and there were all sorts of high inflation problems in other countries. India, on the other hand, chose to take the capex led growth path. So it used that opportunity to focus on infrastructure. So the government came up with this huge parliament building and spent a lot of money there, and that's how from capital expansion the money trickled down to the a worker, the laborer, and that's how the trickle down effect happened. And then the consumption started because the rich and the affluent, you give them 100 rupees, they are not going to spend, they'll save it. Probably it will go into the financial markets. But at the bottom of the pyramid, that 1 rupee goes, then that will go into the direct economy and consumption will increase. So that is very standard and basic economic logic. And with that model, India has so roads are being constructed, flyovers are being constructed. It's a capex led growth everyone is talking about, and that is leading to this capacity building, because of which inflationary pressures are not happening. So on the roads, the bottlenecks are getting cleared because the flyovers are allowing the vehicles to just literally fly over the congested roads. So that part is happening, and this is bit by bit and block by block, this is getting formed across the country. So whether it is investment in high speed Vande Bharat trains, or new educational facilities, or everywhere the supply side is being focused. So PLI schemes and manufacturing, you can see manufacturing over here. You can see manufacturing over here. Manufacturing has grown by a whopping 14%, and manufacturing contributes to something like 17-18% of the GVA. So this is the domestic part which was in place. I mean, when there was fire globally, all that India did was just uh, pulled in the resources, played very compact, got its act together, did not let the public fisc go out of control, debt to GDP stayed in control. And in some way, at the biggest advantage which India has is this huge 140 crore market, if you will. So the domestic economy kept it running in some way, and then of course agri exports also contributed. And that was the that was the domestic part, and we were all just, I mean, even at the height of the uh, or you would say the depths of the crisis of a pandemic and the war, and later uh, there was one thing that was being spoken about India was we are an oasis in the desert. And now that oasis, or now once that sandstorm is going away, and once the clouds are getting cleared and things are becoming better, now India is poised for takeoff, and that can be seen here. And that's what is visible here. So you have fairly flat yield curve and low yields. It's not like Russia or Turkey, which are obviously, I mean, extreme outlier cases, but we have low inflation. Inflation is under that 6%, what RBI tries to continuously bring it under 4% also. So that's one part, domestic. And globally, Fed has unleashed this liquidity rally, because dollar will flow, and currencies will appreciate. And as the currency demand increases, and as India gets added to the global bond indices, the pressure, the upward pressure on the rupee may increase even more. So we will have a situation where we can actually have lower bond yields. So on one side, US bond yields coming down, because of that, Indian bond yields coming down is one thing. This we are all crystal ball gazing over the next 1 year. Foreign funds coming into India, so because of that, rupee getting appreciation pressure. So again, a good thing that the bond yields can come down. A strong public debt to GDP figure, strong fiscal, and all of that translates into this big. I mean, lower interest rates, so lower discounting factors, so higher present value for future cash flows because discounting factors, and that leads to this big rally in Sensex and Nifty over the next 1 year, 2 years, 5 years. Political stability, three election results came, and more or less the market discounted that the continuity will be there in the central government, and the results surprised because of the magnitude of the wins. It was a thumping majority for the ruling party, and that led to the confidence that okay, going forward also the same policy continuity we are having, and that led to not one thing is going against. Now there can be black swan events. There can obviously be, if the election results stun in some other way. This time the state election, okay, you can look at that, the candle, the rupees, even as I speak, the rupee is appreciating. So there's obviously that chance that things can go the other way, but factoring for those unknown black swans, India is well poised for this big up move, economy wise, and because of economy, hence the equity market. So let's just quickly recap this and all of that. Then of course we have got this algo which I always keep talking about, and I have made this script, a single script, where you buy below previous low. Now see what happened was, as long as the market keeps going down, the algo keeps buying more and more. And on days like yesterday and today, when these are big smart big up moves, you don't buy. So that is what everyone wants, buy at lower level, and your average cost keeps going down. I've put it on 15 minutes on Nifty. You can put it on anything, but that's about it. So quick recap. India 10-year G6 are not rising. Indian 10-year G6 are not rising since last two. No, this is not the latest one. This is the one. Global bond yields edge lower after Fed keeps rates steady and hints as much as 75 bips. So that's the starting point. RBI is in an enviable position. Already, it's comfortable with the current liquidity scenario. Daily RBI is either, I mean, even the governor said it in so many words that there are days when I am injecting as well as I am absorbing. So SDF as well as MSF. So RBI is comfortable with that kind of a situation where there is not too much of a liquidity. Bank of England keeps interest rates unchanged. So okay, so again, one more monkey off the back. Withdrawal of accommodation is what RBI is saying, and that's what it is doing. So Indian equities Goldilocks period. So all in all, we are in for a big uh, up move on the Indian equities over the next many years. So that's the update for this thing, and thank you for this main idea. Thank you for the love. Thank you for the followers and the boosts, and thank you so much. Thank you, Trading View. And I need to stop.